Hey everyone. A question was posed to me on TikTok. Someone wanted to know when I'm making an investment, what do I look at with a company? So I thought for this case I would use Apple. And the reason I want to use Apple is really because it's a pretty common stock that everyone owns, but also because I don't want to use a stock that I personally own. Reason being, I don't want 5 years from now someone to watch this video and go, oh, he recommends this stock. Go out, buy it, lose all their money or whatever, and then come and write me all pissed off and going like, hey, you recommended this stock. So it's August, it's 2020, and it's a stock Apple that pretty much everyone owns. So what do I do when I'm thinking about making an investment in Apple? I do a couple of things. There's a couple of things I want to look at. First, I come here on the home page. And one of the big things that's important for me is dividends if I'm making an investment, right? Because dividends are how you compound and build wealth over the long term. It's like taking a little teeny snowball, rolling it down a hill, and by the time it reaches the bottom of the hill, you've got a pretty nice big snowball. With dividend reinvesting, it's kind of like that as well. You start with a little and you add to it whenever you can. So if you have a job that pays well, maybe you get a bonus, maybe you work a couple of double shifts at the restaurant you work at, whatever. Maybe you sell a bunch of stuff on eBay and you can use that money just whenever you can periodically add to a position and use something called dividend reinvestment, you can really build that position over the long term. So you might start with 100 shares, but every year you buy another 10 or 20 or 30 on your own and you get those dividends. The combination of that means, hey, maybe 15, 20 years from now, you've got hundreds, if not maybe even thousands of shares in a position. With a company like Apple, that might be hard to do given the price, but just to give you one of the many examples, I like to come and I look at the dividends. Now, if you look at a stock like Apple, you're going to notice right here, their dividend is pretty weak. It's not even 1%. The standard dividend is around 4 to 5, maybe 8%. 4 to 8% is pretty standard. Anything below is like, anything above that is seen as suspicious or unsustainable. But typically we aim for looking for around 4%. So why is Apple's so low? Because it's really just like a bonus to them. I mean, what are you going to do? Like, to buy 100 shares of Apple would cost you $50,000. And what are you making at the end of the year? 328 bucks. You can't even buy the new iPhone. What are you going to get? What are you going to get with your $328 if you have 100 shares? Like a pair of Beats headphones, maybe? You know, it's more as like an added bonus. It's just like a little, like, look, we've got so much money, we've got so much cash. Here's a little for you. What you really get from a company like Apple is massive growth. So look over here. Now, you can see that this stock has gone up pretty substantially within a 1 year period. If you happen to buy it at around 215 and sell it at around 505, you're making around $7,000 in a year. You mean to tell me that you might not be taking that profit? So one of the things I like to look at is what's the 52-week high, right? Because if it's hit its 52-week high, chances are people are taking their profits. As you could probably see by today, it's down $6. It's a percent. It's not that big considering that it's Apple, but it was 515. Now it's 500. It's pulled back a little bit from profit taking. I would say, for the sake of this video, since we're looking for investments, let's just ignore everything else that's going on with coronavirus and the economy and everything like that. However, in a few days from now, it's August 28th, 2020. Apple is going to be doing a 4-for-1 split. Now, on TikTok, a lot of people are suggesting you sell your position in Apple and buy it back after the split because historically, stocks drop after splits, but historically, stocks also go up after splits. So the caution that I would have, even if this is 5 years in the future and you're watching this video, is if you're going to take a profit ahead of a split, just be aware that you're going to pay, if you've had it for less than a year, short-term capital gains taxes. And even if you've held it for more than a year and you make a lot of money, you're going to pay long-term capital gains taxes. So it might not be in your interest to risk selling the stock on the hopes of buying it back lower when it might just rebound and push higher. So a couple of factors are playing into this Apple pullback, right, from 515 to 500. But I like to look and see where they are in relation to their 52-week high. If they're right at that 52-week high, I might wait, right? Because I'm expecting some profit taking, maybe a little bit of a pullback as people go, hey, I bought the stock way lower. I'm locking in some gains here. And by the way, if you bought it at 202, there's nothing that says you have to sell your whole position. You can sell a piece, you can sell a quarter of it, you can sell half, you can sell 10 shares, whatever you want, to take some profits. If it's way under its 52-week high, I'm also then going to become suspicious. So those are just two things to consider when you are looking at the price of the stock. Next thing I like to do is I like to come over here where this research and reports or reports and ratings are. Now, for a company like Apple, you're going to see it's pretty favorable all the way down, right? Everyone likes Apple. Even the people who are kind of iffy on it are in the middle, right? Neutral, a 3, they're in between best and worst. Most everyone, though, is very positive. They really like the stock, and they're piling in. If Apple doesn't have, well, I shouldn't say if Apple, but any company you're looking at, what I like to do is I like to come through and I like to find the reports that have the best, and I like to read their opinion. You can view, you can click on it, and then I like to come and I like to read the opposing view, right? You can learn a lot from looking at these. So let's just click on Ford Equity. Oh no, is it not letting me? Here it goes. This is Ford Equity's report on Apple. So you can scroll through this. If there's stuff you don't know or you don't understand, Google is your friend. Google what these things mean. If you're really like, what is book value? Just go on Google, type it in, get a really quick, or Investopedia, and get a quick glimpse of what this stuff means. Really though, you can just scroll through and see what the analysts, the people who in theory are smarter than us, have to say about this stock. Why does an analyst really love it? Why does an analyst not love it? If you see a really favorable and a really unfavorable, read them both. You want to be a good investor who knows what you're getting into on both sides. Argue both sides. Yeah, I had a history teacher who we would do these debates. We would have she would split the class in half, and she would say, who wants to be for this case? And everyone would raise their hand, and she would say, okay, this is the for and this is the half, and then she would switch it on us, and she'd say, everyone who voted for is now arguing against, because that's how you become a good debater, is you pick the opposite side. So in this case, get a well-rounded view of what's going on. Read both analysts' reports. Read the good, read the bad, so you know what you're getting into. You can explain both sides of it. So that's one of the things I like to do. Obviously, the more favorable, usually the better. Doesn't mean always that that's the case. It just means in this case, sometimes it is. I like to read through the news. The next thing I like to do is I like to come down to events. And I want to see when all the big stuff is coming out. If it's a company like, let's say hypothetically, let's say we're not looking at Apple. Let's say we're looking at a housing stock or a mortgage stock, something banking, housing, mortgage, home builder, something in that housing category. And let's say that there's some sort of housing crisis. Let's say there's an economic slump and people are not sure how, they're not buying houses because they're getting laid off, right? Let's say there's a recession. If I am looking to buy that stock, maybe I'm going to wait until after earnings. So when I think, oh, I'm going to buy this, I'm going to make an investment in this stock, one of the things I like to do is come down here and see when their earnings are. If their earnings are a week away and I think it's not going to be favorable, but I want to make an investment in that company, I'm going to wait until after their earnings reports come out. On the other hand, if I see, earnings are next week and I'm 50-50 on the stock, I don't really know what's going to happen, one option you have is to go halvesies. If the earnings are coming out in the week and you think it could be good, but it could be bad, and you're not really sure, you don't know what to do, but you want to make an investment of around 100 shares, buy half. Buy 50 shares ahead of the earnings. That way, if the earnings report comes out and it's really, really good and the stock skyrockets, you're not going to be kicking yourself going, I should have bought, I knew. That way, at least you've got a little bit of skin in the game and you can get in and be happy that you at least have 50 shares, even though it's not 100, whatever. And on the other hand, flip side of that is, let's say you think it's going to be favorable earnings and the earnings come out and it's a miss and the stock drops. you can now average down and buy the other half of your shares at a lower price. If it really gets slaughtered, hey, you could maybe even buy more than just the other 50 shares. Maybe you buy 75 more shares. You know what I mean? So that's one of the things I like to do. I like to come down and look at the news. The next thing I like to do when I'm thinking about making an investment is I like to come and look at the charts. I look at a variety of different time frames for the stock. For example, if I look at a 3-year chart on Apple, it's pretty crazy, right? It's like that ball analogy. If I take a ball and I throw it into the air, it's going to gain speed right after it leaves my hands. But after a while, it's going to get to a point where it's unsustainable. That ball can't go up anymore. It's going to reverse course and drop. If I'm looking at a chart, for example, like this, I'm seeing pretty big growth with one little sell-off right around here. But other than that, it's pretty consistently moving up. But you do see these occasional slumps that are buying opportunities before it pushes higher, right? So one thing to keep in mind is, whoa, look at this massive rally from around $200 at the bottom all the way to $500 within a month. Now, granted, we're talking about Apple here, but usually if I saw a chart like this, I would say, you know what, this stock is very oversold. As you can see from the relative strength index, it is oversold. So this is one way you can use charts, which I use most of these. These are Bollinger Bands, and this is the relative strength. Those are my go-to indicators for day trading and swing trading, but you can also use them for the right time to make an investment. If you're not eager to get into the stock, right? You're not eager to get in. You're waiting for that moment to strike. There's two sides to this. Some people say the best time to make an investment in a company is right now, right? Because if you think that you're investing in a stable, secure company that's going to go up over time, it doesn't really matter when you buy it because the hope is over time it goes up. But if you're the kind of investor who's waiting for the right moment to strike, these indicators can help you. You can see here when Apple is overbought, look what happens. It drops pretty substantially, right? It's up here in the 200s and then it drops to the 150s. That's a pretty substantial drop. And again here, it's oversold, it's overbought, and then it drops. So it's up here at around 313 and then it drops to 212. That's about $100 in savings, which on a stock like Apple is pretty substantial. So you could, in theory, look at the relative strength and wait for it to pull back, and that is the opportunity when you pounce. Now, as it happens with Apple, they're going to be doing the split, which is happening in just a few days, right? We're at the end of August 2020. They're doing this 4-for-1 split. So this is all going to be adjusted after that when the price is at a lower level of around $120-ish a share. But it's just something to keep in mind when you see this much growth in this much of a time frame. You might, as an investor, be sitting there going, I'm going to wait a little bit. Now, I like to have up here these three things. I like to have earnings, dividends, and splits on the screen just so I can get a gauge over a long period of time. If I'm looking at a 3-month chart, it can also provide indicators for me on when to make an investment, right? Here is a breakout to the upside. You could buy it here at around 345, and look where it ends up going, to 380s before pulling back a little bit. Here's another breakout to the upside. So these are also buying indicators for you to consider. Now, one of the things with dividends is if I'm buying a stock that pays a dividend, I might want to get in ahead of time. So another thing that I look at is this thing right here, the ex-dividend date. You have to own the stock by this date in order to qualify for the dividend. So if it's August, let's say August 1st, and you're looking at Apple going, should I buy Apple? I'm not sure if I want Apple. And then you come here and say, oh, their dividend is next week. I wanted the stock anyway. I'm planning on holding it for 10 years or longer. I want to get in so I can qualify for this monthly dividend, because if you're enrolled in dividend reinvestment, every little bit counts. Dividend reinvestment, by the way, is right up here under my account. You just click on dividend reinvestment, click enroll, and add the stocks that pay dividends. So that's one thing to consider, is when's their dividend coming out? It's not a reason to or to not buy the stock, right? If it's August 8th and you wanted Apple, you're not going to be like, well, I'm going to wait until next quarter to get it. But it can guide your decision as to whether or not you want in or not. If the dividend is coming out next week and it's a company that pays maybe a substantial dividend, you might want to get it. With Apple, you're not getting a substantial dividend because what you're getting instead is substantial growth from the stock, right? This $203 to $515 is over 100% increase in like no time, right? It's 100%. I believe it's 100%. Let's go to the percentage calculator. Let's just do 200 to 500. It's 150% increase in the stock price. That's pretty substantial. So do you really care that they pay under 1%? You know what I mean? So the last thing we want to do, is click on the fundamentals. This will tell us where the company stands in terms of revenue and debt and stuff like that. If you click on the income statement, it's going to show you the revenue. Anything past this comma is billions, right? It says up here, values are displayed in millions. So this 174 will go all the way up to 999. That's $999 million. When it crosses over, it becomes billions. So you can see Apple is doing all right. One of the things I want to look at when I'm making an investment is, are the revenues increasing? It doesn't have to be year over year, right? We can see that there are certain anomalies, right? Apple is 215 after being 233, and then it's 229, and then it's 265, and then it's 260. So it's not a consistent year after year increase, but these numbers are still pretty substantial and pretty great. Another thing I like to click on is the balance sheet. I want to look at how much cash they have, how much debt they have, how many liabilities, right? You're going to expect companies to have liabilities. You're going to expect companies to have a little bit of debt. It's not unreasonable that they will have debt. You just want to see that the debt is being managed, that it's not some catastrophic level of, hey, the debt was, 15 million and now it's 70 million and then the next year it's 150 million. That could be pretty bad. So those are the things that I look at when I'm thinking about making an investment. If I've left something out, please leave it in the comments below. We can do a follow-up video. We can cover more ground if you think that would be helpful. Otherwise, please hit like, please hit subscribe. Thanks for watching. I hope this video was helpful for you, and have a nice day.